Hello everyone, welcome to today's session. So today we are going to discuss on the chapter number 14, unit 1. The way we discussed in the last session, we are going to continue our discussion today. Before I proceed, any doubt on chapter number 14 or whatever we have discussed till now? Any doubt on any of the part? Yes, no? No? Okay, fine. Okay, so if there are no doubts, then let's proceed for the discussion. So today what we are going to do is, today, first of all, we are going to take some questions so that whatever we have revised till now, whatever we have learned till now, we will practice that topic. And by practicing, by solving those questions, we will see how to answer, on the topics of bank audit. With the help of questions, more and more questions, we will try now go on the part of the auditing and reporting. Okay. So let's go to the question part. Let me read straightforward. The first question is straightforward, simple question. There is nothing difficult with that. Okay. So let me read that particular part for you.
A major part of the assets of a bank, requiring significant attention from the auditor primarily. What are the specific areas regarding which an auditor seeks to obtain evidence while auditing advances? Furthermore, outline the suggested audit procedures specifically for the evaluation of internal controls over advances.
So the question was, advances generally constitute a major part of the assets bank. Okay. Requiring significant attention from the auditors primarily. What are primarily? Now you as an auditor are required to provide what are the specific areas, okay, regarding which an auditor seeks to obtain the evidence while auditing the advances. Number one. Number two, outline the suggested audit procedures specifically for the evaluation of the internal control over the advances. So we are required to answer two things. One, what are the specific areas regarding which auditor seeks to obtain evidence while auditing the advances? So take a minute, read the question, and then try to answer it. Take a minute, very small question, but read the question and then try to answer. Okay, now tell me, how will you audit? Okay, Ayush, very good. One is the classification of advances. Yes. What else? What is the other area that you will look into? For which, or what are the other areas for which you will go for the evidences? Anyone? Come on, guys, quickly. Advances. We have seen this. We have discussed this. Regularization near balance sheet date. Very good. Yes. What else? Quick NPAs. Yes. Very good. So what we will look for, or the areas we will look for the advances. Number one, you can say that we will look for installment amounts, EMIs, interest rate. They should be appropriately entered into CBS system. Okay. They should be appropriately entered into the CBS system, core banking system. Second, when we talk about advances, we need to verify, okay, whether all the advances are appropriately tagged to the customer. Tagged to customer. Why? Reason because now NPA classification is borrower wise, not facility wise. Okay. So NPA classification is borrower wise. So we need to tag each and every loan to a particular customer. Third, large advances. We need to look for the large advances on sample basis, testing kind of thing I'm talking about. Fourth, early warning signs, early warning system, SMA classification, SMA 0, SMA 1, SMA classification. Okay, early warning system. Then we talked about, okay, what we will do is we will go and check any account or loan where internal, external auditors have provided adverse comment. Why? Reason because those will become or they can be classified as a loss asset. NPA classification, quick NPA or quick mortality cases. Okay. Then income recognition. Then you can also perform other procedures. For example, procedures as per SA 520. What is this SA 520 procedures? Anyone?
Analytical procedures.
Very good. Analytical procedures, SA 520. Analytical procedures. You can perform that. So these are certain things that you can look into with respect to the advances. Now, this was with respect to your auditing the advances. What about internal controls over advances? Can anyone tell me about internal controls over advances? What type of internal controls or what areas you will look into when we are talking about internal controls in case of advances? Anyone? Internal controls or areas we will look into. What procedures you will perform? Let's talk about procedures specifically that you will perform to evaluate the internal control. Anyone? No? Okay, let me tell you. See, when we talk about internal controls, evaluation of internal controls, the procedures that we need to perform. What procedures we need to perform? And the areas we have discussed, the procedures will be somewhere nearby only. For example, first, we will examine the area of credit appraisal. Who has done the credit appraisal? We will verify whether the advances are sectioned as per the delegation of authority. I'm talking about controls. control segregation of duties, delegation of authority, whether all the documents have been, executed before the loan is dispersed, whether the compliance with respect to the relevant bank policies is done or not. So these are certain procedures, whether the drawing power is calculated. So these are certain procedures that we will specifically, look into for the evaluation of internal controls over advances. Clear? Any doubt? Pretty easy question, and a lot of things that we have already discussed in yesterday's session. So, kind of a quick revision of what we discussed yesterday. Any doubt? Any doubt? Okay. If no doubt, let's take one more question. And this is good one. This is kind of a case scenario, or a scenario basically, where you will be required to evaluate the situation. TBR and Associates have been appointed statutory central auditors of Vikas Bank Limited, a nationalized bank, for the financial year 31st March 2024. During the course of the audit, the engagement partner T observes the following specific loan account. Borrower Mrs. Solar Infra Private Limited or Solar Infra Limited, a public sector undertaking. Term loan, outstanding balance 50 crores. Fully secured, guaranteed by the central government. Principal interest remained overdue since 2023. That is overdue for more than 90 days. Okay. Bank has classified the account as a standard asset, reasoning that the guarantee has not been invoked or repudiated. Bank has recognized the income of 4.5 crores on this account on accrual basis. The bank management argues that since the loan is backed by the sovereign guarantee, that's a guarantee given by the central government, it cannot be treated as an NPA. Consequently, income recognition accrual basis is justified. You, as a statutory auditor, evaluate the appropriateness of the bank's accounting treatment regarding the asset classification, income recognition with reference to the prudential norms. So, with reference to the prudential norms, tell me whether this asset classification and income recognition is appropriate or not. Easy, pretty much. Take a minute, read the question, and then try to answer. Okay, now tell me, what do you think? Is the bank correct or is the bank incorrect in this particular scenario?
Treatment is inappropriate in this case because the
Hmm.
principal and interest both have remained overdue for more than 90 days.
Hmm.
So there have not been any credits also. And
Okay. Bank is incorrect.
yes, I mean, the guarantee by the central government is also not relevant in this case because it has been overdue for 90 days.
Okay. So it, as per you, it should be NPA. Income should not be recognized. Any other answers? Any other answers?
And the interest has been recognized on accrual basis, which that also is not appropriate.
Yes. Okay.
It should be done on the receipt basis in this
Okay.
case.
Hmm. So interest recognized on accrual basis, that is also not correct. Okay. Any other answers apart from this one? Okay. Now I will take you to one specific point as a part of the prudential regulations. We have discussed this with an example. Hmm. Remember this point, we also discussed with an example. If something is backed by the central government guarantee, we do not count that as a NPA. I'll take you to that specific example. Yes, this one. Advance covered by ECCG guarantee or any central government guarantee. I will not count this as a provision or NPA part. Reason because for me, this is backed by central government. Central government. I cannot say this is become non-performing or I will not recover any amount out of it. I will not classify this an NPA because I will say that okay, see, if something is backed by central government, it is backed by. There is zero chances of going, like incurring loss on that particular loan or asset. There is a part. This is a part of the prudential regulations also. I'll just show you. Yeah. So if you see, the credit facility is backed by the guarantee of the central government. Though overdue may be treated as NPA, this is very important part. Only when central government repudiates its guarantee when invoked. That means if you invoke the guarantee and you go to the central government give me the money. And if central government says no, I will not give the amount because there are violations or there is an issue, then only it has to be treated NPA. Otherwise, any credit facility which is backed by the central government is not required to be treated as an NPA. This classification or this exemption from the classification is for the purpose of NPA and the provisioning, but not for the purpose of income recognition. That means I am not required to recognize income on this particular asset. This particular assets will still be worked upon cash basis because it has crossed the limit of 90 days. So in this particular example, classification is correct, but income recognition is incorrect. I should not recognize 4.5 CR of income on accrual basis because the amount is outstanding for more than 90 days. Okay. There is one more area that we as an auditor should look into. That if the amount is outstanding for more than already 90 days, okay, it was outstanding since September, why the guarantee has not been invoked yet? And this is a part of the audit. Okay. So when you do a audit, when you come to a reporting part over there, you look into the particular assets or particular credits where you have still not invoked the guarantee or have not still invoked the whatever security is there. Okay, so these are certain matters that we as an auditor are required to look into when we are auditing. If there is a particular asset where there has been uh, and any of the kind of security is there but we are not invoking it. Is there any kind of guarantee which we are not invoking? So those are the kind of asset that we should have the eye on. And with respect to the scenario, Classification correct, income recognition incorrect. Any doubt? Any doubt till now? And did you get the answer? Like why the answer is this way?
Yes, clear.
Okay. Now I will show you. There is one question, how to answer, like what should be their regulations. Okay, I'll show you the answer also. See, when you have to answer this particular question, what you need to do is simple. The method we use to answer the question, that is, you first provide the provision, which is provision is there. Asset classification or whatever the provision may be that you remember, you specify the provision, you do the analysis of the case. Okay, what is the analysis? Then give your conclusion. For example, asset classification is correct, but when it comes to the income recognition, that is incorrect. So this is how you can write the answer for these type of questions. Give the provision, whatever you remember, then do the analysis of the case, and then give your particular conclusion over the case scenario. I hope I'm clear. Okay. Now we will go to something which is with respect to the appropriate reporting that is done. I will show you something with respect to the reporting part. And in case of the advances, see, again, we are coming back to the LFAR. Okay. And this is a specific part I'm just showing you as of now, where we are talking about the claims when we have these central government guarantees back. So as an auditor, we are required to provide that have appropriate claims for the credit guarantee, ECCG and others, if any, has been duly lodged and settled. If it has not been lodged, we are required to give the details over here. Why those credit guarantees have not been duly lodged. Okay. If not, then we need to provide the reason, like what was the reason why they have not been lodged and why there's a delay in invoking the credit guarantee. So we need to provide the claims at the beginning, further claims lodged during the year. Okay, then claims accepted, claims rejected, and balance at the end of year. So if there are any claims rejected and the rejection is appropriately considered, determining the provision requirement. So what will happen if there is a rejection? What will happen if there is a rejection?
The asset will become NPA.
Absolutely. The asset will become NPA, and now all the provisioning requirements, whether substandard, whether doubtful, will be applicable to it. And accordingly, you are required to now make the provisions. So it will turn into an NPA, and then provisioning requirements will start immediately. So whatever category it is falling, it may happen that directly it is falling into the doubtful, because sometimes claims take time. Okay, so it may happen that directly it is falling in the category of doubtful. So you need to make sure that you are reporting those things appropriately in the LFAR also. Any doubt? Okay. So let's go through further reporting requirement that we have in the LFAR for the advances. Okay. What we are required to report and why, whatever we have discussed with respect to the auditing point, how it is relevant. See, when it comes to the advances, we are required to report, there are multiple sections. This is for the branch auditors, specifically I'm talking about. So there are multiple sections under which we are required to report. For example, remember, one was the large advances. So we saw that there is large advances and we are required to check on the sample basis. So in the audit report itself, we are also required to provide, are there any large advances? In respect, like if the outstanding amount is excess of 10% of the outstanding aggregate balance of the fund or non-fund advances of the branch, or 10 crore rupees. If yes, then we are required to check for those large advances. Okay. So we are required to check, for example, the process needs to be checked. The transaction audit is required to happen. The relevant details are required to be checked into for that particular advances. Documentation is required to be checked. So the large advances which are more than 10% of the outstanding amount for the branch or 10 crore. Okay, on sample basis, we are required to look into these details, specific details. We are required to look into the specific details and we are required to comment on that. Okay, that's where the audit requirement for the large advances is coming from. Then you need to provide the list of those advances, the large advances that you have seen. Okay, in this particular format. Then you need to see credit appraisal for those advances. What is credit appraisal? That means whether the limit enhancement has been done or not, if there is a CC or OD. If it has been done, then what documentation was referred to, whether appropriate documentation has been saved or not, whether the credit appraisal is as per the bank policy or not. Okay. Then have you came across the quick mortality accounts that are dying within 12 months itself? And if yes, provide the details like account number, account name, and balance at the end of it. So the quick mortality is coming from here. You are required to report in the LFAR. Interest rate appropriately fed into the system. Now, system, remember we talked about CBS. Okay. Then interest rate benchmarking. So a lot of time, you might have heard that policy rate has been changed. Repo rate has changed. Now interest loan rates will be changed. So whether those rates are revised or reviewed periodically as per the floating rate guidelines, or whether if they are linked with any external benchmark, MCLR, EBLR, then whether it has been revised as per the guidelines. For example, another case is frequent rollover of short-term loans. Can anyone remember we talked about a concept called evergreening of loans when we were discussing the CARO? Anyone? Evergreening of loans when we were discussing the CARO? Yes, no? That you give another loan to the borrower so that he can pay the first loan. And by this way, you reduce or you change the aging of the loan. So let's say, for example, the borrower was supposed to pay 100 lakh rupees or let's say 10 lakh rupees. Now, in order to facilitate that payment, you gave him another 10 lakh rupee loan. And what he did is he paid the old loan of 10 lakh rupees in your books. Now the loan is freshly given, which is outstanding, and old loan has been paid. That is the frequent renewal or the rollover of short-term loans, or you can say evergreening of loans. That you pay or you provide the funds to pay off the old loans. Frequent rollover. Then appropriate credit rating with respect to the sanctioning, whether appropriate higher authorities are involved into when delegation of authority. This is something we saw in the internal control also. Delegation of authority for the sanctioning. Whether the terms and conditions of the sanctions have been complied. Okay. Documentation part, whether documentation has been maintained appropriately or not. Review monitoring. This is something after issuing the loan. For example, balance confirmation, acknowledgement of debts, if there is any, or periodic review of advances that you are required to do. Then drawing power properly computed or not, whether you have obtained stock or data statement, periodic statements that are required to be obtained. Okay, whether latest audited financial statement are obtained or not. So how old this can be? How old a stock or data statement can be, which can be used by the bank? If I have to utilize that stock statement or data statement to compute the drawing power, how much old it can be?
3 months.
Very good. It can be only up to old of 3 months, beyond which I need to obtain the fresh stock statement or data statement. So this is 3 months. It should not be more old than that. So you need to compute the drawing powers. Okay. Again, if there is a stock audit requirement, you need to get it done, the stock audit timely. You need to appoint the auditors. As a bank, you need to appoint the auditors. And then where the stock audit was not conducted, you need to provide that. If it was conducted, but there are adverse opinions or adverse remarks, that is also is required to be reported. Then a lot of things are there. Physical verification of the securities. Then deficiencies or you can say diminution in the value of securities. If there is a diminution in the value of security, inadequate insurance coverages that you need to look into, deterioration in the value of security, if there is any. The question is, are we required to learn all these things? See, you are not required to, what you can say, mug up all these things. Logically understand as an advance what you are required to look into. These are the examples that I'm discussing with you. Now, it's not something that you need to mug up the entire report. No. This is for the understanding purpose, why and what we do in the audit. And if you logically understand, that is only you need to write an exam that we are discussing. The way we saw the particular question also. So if you logically understand what is and from where it is coming, you will be able to answer the question. Now, let's say for example, in your study material, I have this part. These are the things we have already discussed. But why we have to do this? This is written over here. The substantive audit procedures, these are written over here. But why we have to do these substantive audit procedures? Just because it is written in the book, that's not the reason we should do the substantive audit procedures. There should be a reason behind each and every procedure that you are performing. And that's what we are understanding. The reason is the reporting part. Whatever procedures we are discussing, everything is linked to the reporting. Reporting in case of the bank audit is very crucial, and your procedures more than the normal audit procedures, your procedures which focus on these reporting areas are more critical because you have to provide that information as an auditor. Clear? Then you are required to cover on large advances. You are required to report on large advances. You are required to report on security creation, insurance. All those things are there. Okay. And then asset classification. As I said, as we discussed, asset classification, standard, substandard, doubtful loss, SMA 0, 1, 2. Okay. Then there are multiple things in case of asset classification, but we are just seeing some few of them. Like for example, income recognition, provisioning. So whether these have been followed or not. Okay. We saw with the credit guarantee part, whether credit guarantee part is there or not. So these are certain parts where auditor is required to report and auditor is required to perform additional procedures. Now, we will look into one more specific area. And before we proceed to that specific area, any doubt with this one? Any doubt in the advances? Yes, no? Okay. If no doubts, then let's proceed to one more important area that I want to discuss with respect to some specific, you can say, reserves that the bank is required to create. So we will talk about some specific reserves that the bank is required to create. Okay. Do you know what is CRR and SLR? If you have gone through the chapter, if you have read the chapter, you will be aware about that. What is SLR and CRR? Anyone?
Cash reserve ratio,
Yeah. And
Statutory liquidity ratio.
okay. And what are the basically rates which are as of now in force for these particular reserves? Anyone? For the banks?
CRR it's 3.75, I believe. SLR is 18%. It's continuing more than 5 years. Same rate.
Yeah. Very good. So, yes, you are correct. So, current rate for the CRR is 3%. As of today, if I talk about it, it's 3%, and SLR is 18%. Okay. Now, why and what is the use of these reserves and why these reserves are required to be created? See, these reserves, the requirement of these reserves basically come from different part of the regulations and act. Okay. So we will see what is the requirement from where it is coming and how the bank is required to fulfill the requirement of these reserves. Okay. So let's go first for the Banking Regulation Act. I will first go to the Banking Regulation Act and then we will go to the RBI Act also for this particular purpose. Just a minute. So we will look into first a section called Section 18 of the Banking Regulation Act. Section 18 of the Banking Regulation Act. Go to that. This is the Banking Regulation Act which I have opened. Let's quickly go to the Section 18. Yeah, this is cash reserve. Section 18 basically talks about a cash reserve. So this particular section, and we have a RBI Act. Okay, we will also go to the RBI Act, which also places similar response. What you can say, responsibility over the banks to maintain these kind of reserves. Okay, but let's first focus upon the Section 18. Now, Section 18 talks about that every banking company, not being a scheduled bank, shall maintain in India on a daily basis by way of a cash reserve with itself, or by way of a balance in the current account with the Reserve Bank. Okay, of such percentages that is provided, okay, every time by the Reserve Bank of India. And how it is required to be calculated? Of its total demand and time liabilities in India as on the last Friday of the second fortnight or second preceding fortnight, as RBI may specify by notification from the time to time and all those things, and shall submit to the Reserve Bank before 20th day of every month, showing the amount so held on alternate Fridays during the month with particulars of its demand and time liabilities. That means on every alternate Friday, second preceding fortnight. last Friday of the second preceding fortnight. That is twice a month. Okay, you can say kind of twice a month. Whatever your total demand and time liabilities are there, total demand and time liabilities. Of that, a percentage is required to be maintained either by itself or by way of a balance in current account with a reserve bank. And every 20th, okay, every 20th, what you are required to do before 20th, what you are required to do, you are required to report about this demand and time liabilities. That is written in this particular act. That's a section 18 that we are talking about. Now, what is the demand and time liabilities? You guys might have already gone through the chapter. So can anyone tell me what is demand and time liabilities that we are talking about? Anyone? Anyone? No?
Demand against the fixed deposits and savings account.
Okay. So basically, let me show you. Now for this particular purpose, okay, what they have defined is the term liabilities in India. And they have defined this particular term, liabilities in India, shall not include this. Okay, so these are the things which should not be included in the liability, but rest you can include in the liability. What is not included? Paid up share capital, advance taken from Reserve Bank or National Housing Bank or SIDBI or National Bank for Financial and Infrastructure Development. If you have taken advances from them, not required to be counted. Paid up share capital, not required to be counted. Advances from authorities. In case of a regional rural bank, any loan taken from the sponsor bank, that is also not required to be counted. Okay. So these are the things you are not required to count in the liability part. Rest you can count. Rest of the liabilities you can include. Okay. Now, when I talk about demand and time liabilities, basically the term demand and time liabilities, it is the term like based on the liability that is required to be paid, whether it's based on the demand when someone asks for that liability to be paid, or it is time-based payment. So these are the demand and time liabilities basically. And these are certain liabilities which are required to be included in calculation. But majorly everywhere, if you see the regulation, RBI has provided the guidelines what is not required to be included, and apart from that, you include rest of the thing into the DTL. You include rest of the things into the DTL. For example, in your study material also, you have a page number 14.21. Over there, you have a list that liabilities that are required to be excluded. This is not the time demand or time liability. It is not a liability kind of thing. That's why RBI says that please do not include this. Exclude this from the calculation of demand and time liability. Okay, and that is the way we saw paid up share capital, then amount of refinance taken from Exim, NHB, NABARD, SIDBI. Then there are other circulars which provides that you should not take these kind of liabilities. For example, bill discounted by a bank with eligible financial institution as approved by the RBI. Net income tax provision, it is not a liability. Income tax provisions are not liability. Amount received from DICG, that is again credit guarantee. Okay, credit guarantee for. Now again here you are holding that particular amount towards a claim for any pending adjustment. That means you have received an amount there is claim is required to be adjusted, details are required to be adjusted, but you have the amount with yourself. Again, amount received from ECGC by invoking guarantee. Amount received from insurance companies where the claims are pending for the judgment of court. So the adjustment is still pending, but you have received the amount. Amount received from the court receiver in case of a liquidation or something, all those things. Unrealized gain or loss from derivatives. Income flows flows that is received in advance, okay, such as annual fees, other charges which are not refundable. Because we have received it, we are not going to return back. It is not a liability like demand or time liability. Demand liability means someone will come and demand and we have to pay that amount. Time liability means that after a particular time in future we are required to pay that amount back. But income which is received in advance, which is not refundable, we are not required to pay. Logically, it should not be part of DTL. Liability arising on account of utilization of this BAF facility, which is there with the RBI. Again, facility given by RBI, anything with respect to RBI do not count into DTL position. Parts of amounts recovery from the borrowers in respect of debt considered bad and doubtful. Because once you recover the amount which is already considered bad and doubtful, for which you have already provided the provision, as of now, that is written off. Initially, it is written off. Once you receive the amount, you book onto the liability side till the time you again back, adjust all those things. Again, the provision, you reverse the provision, you bring the data back or asset back and then adjust in front of that asset. Till the time, it's a part recovery adjustment pending, shown in the liability side, do not count as the DTL. Amount received in Indian currency against import bills, held in sundry deposit, for which the receipt is pending for the final rates for the adjustment. Again, some adjustment is pending, okay, and for that do not count the entire bill amount, okay, as an DTL. Undeposited balance lying in the link branches or dividend warrants or interest warrants, something like that. The balance is there, which is yet to be adjusted, but it is lying with the another branches. So do not count that as also a DTL. Margin kept in or held in sundry deposit for funded facilities. Again, these are the margins. These are not something, you are required to pay back. So that's why also do not count this as a DTL. So these are required to be excluded from the DTL. Clear? Any doubt? So apart from this, what we do is we calculate rest of the things into the DTL position for the CRR. Yes or no? Any doubt? Any doubt with this? Okay. Now, you should ask the question, sir, we saw the Banking Regulation Act. We saw the Banking Regulation Act, but you excluded scheduled banks from this. You excluded scheduled bank from this. Why? Then where these scheduled banks are covered? Then where these scheduled banks are covered? Anyone? We excluded the scheduled banks from this, but the question comes is where these scheduled banks are now covered. So except for scheduled banks, everyone is required to maintain. Is there any exemption to the scheduled banks? Yes, no? No, there is no exemption to the scheduled banks. Now we will see the RBI Act Section 42. Okay. So let's go to the Section 42. I think it's on page 50. Yeah. See this one. Cash reserve ratios of the scheduled banks to be kept with the bank. Similarly, every bank included in the second schedule, is required to maintain with the bank an average daily balance of the amount which shall not be less as such percentage which is provided from time to time of the total of demand and time liabilities of the India. Okay, the way we saw in the Banking Regulation Act, Section 18, similarly it is there for the scheduled banks and Section 42 of the RBI Act. And again, what is average daily balance, what is fortnight, liabilities, what is required to be included, not included, everything is given. So those things are already given that we discussed in the study material itself also. But these are the things which are given. Okay. So for scheduled banks, it's the Section 42. For the rest of the things, it's the banking regulation. Okay. Now, again, as banks are required to report, auditors are also required to look into whether the banks have maintained this particular position from time to time or not. So as an auditor, we should be aware that how basically these demand and time liabilities are calculated, and the bank has applied the relevant percentage to calculate appropriately. So there is a way that the banks are required to submit this particular report to the RBI. For example, the Act provides that every scheduled bank, and same on the banking regulation, that return signed by the two responsible officers. Now, if you are an auditor, you have to see that whether it is signed by the two responsible auditors or officers. Okay, whether it is classifying all the liabilities into the demand and time liability section. Then balance held at the Bank of India, balance of legal tender notes held in India, balance lying with other banks. All those things, these things are required to be provided in the return. And as an auditor, we should be aware what is required to be provided. Again, this is same fortnightly, alternate Friday, all those things are applicable over here also. The way we saw in the Banking Regulation Act, the similar it's applicable over here also. Clear? Any doubt? Any doubt? Till now, whatever we have discussed on the CRR, we are just talking about CRR. Now, see how it works. As an auditor, again, it's a part of the bank that we discussed. But it should not be the only part that we have discussed. Like, as an auditor, it should not be the only thing that we are required to report. There are multiple things that we are required to look into with respect to the CRR and SLR. I'll come to the SLR in a while. But let's go to the audit report and see, as an auditor, what we are required to report. Okay, as an auditor, what we are required to report with the CRR part. See, this is again the LFAR, and over there, we as an auditor are required to report that any discrepancy in the process of compilation of calculation of net demand and time liabilities by the bank should be highlighted in the report. It should be specifically commented whether the bank has complied with the CRR and SLR requirements and with the instances of the non-compliances thereof. How will you do this? If you have to report this, how will you do this? Anyone? Simple question. In order to report this, as a statutory central auditor, how will you perform the audit procedures and what you will do to report on this point?
Sir, as we discussed on that second fortnight of the previous Friday, we will check for the every month, and is there any deficiency, we will report with respect to CRR
Hmm.
in the LFAR, whether complied or not complied.
Okay. Anything else that you will look into?
But with respect to SLR is a different story. That every month, odd, not on the Friday, we will select 1 month.
Hmm.
Totally 12 date we will pick on the whole year, and in particular date we will check the SLR requirement is met or not.
Okay. I'll basically I'll come to the SLR point also. We will come to the SLR point. But yeah, uh, anything else that you will look into for the rates or for this calculation of demand and time liabilities? Anything that you will look into?
Since CRS is the rate is different from
Hmm.
based on the month over month or quarter, that rate we have to check it based on that particular month applicability rate.
Okay, month on month rate, yes. Anything else? As a statutory central auditor, how you will make sure that this is done appropriately? How you will make sure that this is done appropriately? Okay, very good, Sarah. But my question still remains the same. You are the statutory central auditor. Focus on that. Statutory central auditor. When you say whether banks are properly calculating this requirement, do you think you will check at the bank level? Means, in order to say that, like to check at the bank level, to check at the entire bank level which is there in India, is it something you will just go to the management and ask the details and then check whether it is appropriate or not?
Sir,
We will
here
check
the
in CDS.
okay, here
Mhm.
actually two questions will arise. One is the branch level, one is the bank is entirety.
Okay. Yes, very good. Now, this particular requirement, when I talk about CRR or SLR, this is something is also required to be at the branch level. Now, when I talk about at the branch level, each and every branch submits the calculation of the DTL to the head office, and then head office consolidates that, and on the basis of the consolidated position, these requirements are calculated. How much CRR is there and how much it is not there. So, as a statutory central auditor, basically you have to rely upon the details which are submitted by the branch. Now if the branch is submitting something, you would like to look into the that okay, this information which is coming from the branch, then the branch auditors must look into this information. So branch sent to their head office, branch auditors sent to statutory central auditors, the same information verified. Auditors then are required to verify the correctness. Okay. Then once you receive the information, on the basis of that, you examine whether that ratio is being followed or not. So it's not only checking, it's the coordination with the branch auditors who will send you the trial balances. as on Friday. Okay. So that you can consolidate. Now, one thing is very important. When we read the particular section 18, what it says that shall maintain on a daily basis. This is very important. Shall maintain in India on a daily basis by way of a cash reserve. Now, to calculate that cash reserve, you need to use a formula which is a sum equivalent to a percentage of its total and demand liabilities on the last Friday. So that's a formula. But whatever amount it comes on a daily basis, you are required to maintain that. So it's not only about calculation part, it's about the maintenance part that we as an auditor are required to look into whether the CRR was maintained on a daily basis or not. Are you getting the point over here? So one part is basically with respect to your calculation. Yes, we are required to calculate demand and the term liability. Second part is with respect to maintaining on a daily basis. So again, that's why we will go to your study material. That's why as an auditor, okay, so you need to request the branch auditors to send their weekly trial balances on the Friday. These are consolidated at the head offices. You then see that whether the DTL position is determined is correct or not, because you are the statutory central auditor. And then based on the details that you receive from the branch auditors, you verify the calculations, and then you see whether basically the position which was there and the reserves which were there are maintained appropriately or not. You also may go for the test basis, checking on the test basis on the consolidated DTL position. Okay. For example, you may check some, once it is coming from the branch auditors, it is audited by the branch auditors, reviewed by the branch auditors. You may also go into and look into, okay, on sample basis, whether it is being calculated appropriately or not. Okay. So that is the one part that you may do. Then you will see whether the things are excluded appropriately or not from the particular calculation from the DTL. Then there are other things also which are required to be included. Again, there is a guidance. From time to time, RBI provides with respect to the parts to be included and parts not to be included. Okay. In the these liabilities. So there are certain parts which are required to be included in your demand and time liabilities. So as a result, then you are required to look into that whether those parts have been included or not. Then there are certain forms basically which are required to be submitted by the bank. Okay. There is a written A, there is a form A, form B. Okay. Then there is a form 1. So there are multiple forms. These forms basically are with respect to reporting on the CRR and SLR. Again, I'm talking about the regulations only. These comes from the regulation itself, and I'll show you just one.
Yeah, for CRR form A, for SLR form 8.
Yeah. So just a minute. Again, these are some master directions. Again, they are very important master directions because these are applicable to each and every bank. Basically, what it says that the maintenance of CRR shall be reported to the RBI under Form A for these scheduled commercial banks, small finance bank, payment bank, local area banks. Form B for the scheduled cooperative banks, and Form I or Form 1 you can say for the non-scheduled cooperative banks. But maintenance of SLR into Form 8 for the scheduled commercial banks and Form 1 or I, what you want to say, for all the cooperative banks. And here they have specified what aggregate deposit means, okay, what approved securities are there for the SLR purpose. A lot of things they have specified in this. What is the average daily balance? And if I talk about what things you are required to include in case of the demand deposits, okay, what things you are required to be included in case of net balances in current account. A lot of things have been specified in this particular regulation, which is required to be followed by the bank. So, for example, I'll show you one. This is the time liabilities that has been defined. Time liabilities of a bank shall include those liabilities which are payable otherwise than on demand, including fixed deposit, cash certificates, cumulative and recurring deposits, time liabilities portion of saving banks deposit, staff security deposits, margin held against letter of credit, deposit held against securities, and gold deposits. These are time deposits. But let's talk about then demand deposit. What is demand deposit? Deposits that are also defined. These are the demand deposits. These are the kind of and demand liabilities. So demand liabilities means liabilities which are payable on demand, including current deposit, demand liabilities, portion of saving banks, margin held against credit, letter of credits, balance in overdue fixed deposits, outstanding TT transfers, unclaimed deposits, credit balance in cash credit accounts, deposit held as a security. So when we call demand and time liabilities, these are defined based on which is required to be calculated. So as an there is a question. What is the purpose then of to give excluded list or negative list when the positive list is given? See, when we talk about the positive list, what it is very generic. When I talk about current deposit, very generic. Balances in overdue fixed deposit, cash certificate, cumulative or recurring deposits, unclaimed deposits. These are very generic. But when we discussed about the negative list, they were more specific. I'll just take you back to the negative list. For example, net income tax provision, amount received. See, specific we are talking about amount received. Maybe you have shown something in portion of that generic liabilities. Maybe it is shown as a part of the generic liabilities. But you need to exclude that. The way we saw time liabilities was showing fixed deposits or cumulative and recurring deposits. Plus, there are other circulars which specify what you need to include. Again, those are more general and generic. These are more specific. So you need to exclude the specific ones and you need to include all the rest of general things in that. I hope I'm clear. Any doubt? For example, I'll show you one more. There is a term called other time and demand liabilities. Sorry, other demand and time liability, which will include interest accrued on deposits, bill payable, unpaid dividends, suspect account balance, okay, net credit balance in branch adjustment account, any amount due to the banking system, which is not in the nature of deposit or borrowing. It will cover everything. Balance outstanding in the blocked accounts pertaining to segregated outstanding credit entries. A lot of things are there. Okay, then borrowing through investments, instrument qualifying upper tier 2, or this is specific one. But if you see, this particular part will cover a lot of things, which is general. So check for the negative part, check for the part which is more specific, negative list, and exclude that. Okay. So that is how you as an auditor are required to check whether this is calculated appropriately or not. And then you are required to report that whether bank is following this particular calculation appropriately. See this one. The auditor should examine the correctness of the data in Form A in CRR and Form 8 in SLR. So this CRR and Form A and Form 8 is coming from these regulations which we just now discussed. As an auditor, we are required to report in that. Oh, as an auditor, we are required to verify those things. Clear? Any doubt? Any doubt till now? Okay. So this was CRR part. Again, similarly, we have a SLR also. SLR reporting requirement and SLR calculation requirement, which is coming. Okay, from the act itself. So again, you are required to maintain the SLR balance, liquidity ratio, okay, in form of certain liquid assets, as gold, as a cash, okay, with the either as a gold, as a cash, or as a government approved securities. Now, again, as an auditor, we are required to report upon the SLR also. So, that we just now saw. That CLR, SLR requirement, we are required to report on that. That as an auditor, whether we see that bank is complying with the SLR requirements or not. So, we need to understand what are the requirements and from where it is coming, then only we will be able to report on these requirements. Otherwise, we will not be able to report on these requirements. Okay. Any doubt with respect to this part also? Like it's SLR is more onto the formulas, that there is a formula given for the SLR, okay, which is the liquid asset divided by net demand and time liabilities, and on the basis of that you need to calculate percentage for the SLR. Okay, now why SLR is coming into the picture? So again, you can say Banking Regulation Act and RBI Act is there. So I'll take you to the Banking Regulation Act and the RBI Act for this one. See, Section 24, that is the maintenance of percentage of assets. Now this section provides that a scheduled bank, in addition to the average daily balance, which may be required to maintain under Section 42. What was 42? CRR. And Section 18 of the Banking Regulation Act, CRR. Okay. In addition to that, means SLR is in addition to that. Okay. Shall maintain in India assets value of which shall not be less than such percentage which is specified. Okay. Not exceeding 40% of the total of its demand and time liabilities in India on the last Friday of the second preceding fortnight. Means whatever percentage will be less than 40 only, because the X provides the upper limit. Currently is 18%, but you are required to maintain assets, which is saying assets, and value of which should be percentage based on the total rate of its demand and time liabilities. And again, the RBI will specify that how to calculate those demand and time liabilities. Plus, you are required to file a return for this particular purpose. Okay, so furnish a return, furnish to Reserve Bank for ensuring the compliance in the prescribed form we just now saw, form 8. Okay, in the manner, in a monthly return. Okay, on which date? Not later than 20 days after the end of month. Same, before 20 days. Before 20 days, before the 20th of every month, we are required to provide, or the bank is required to provide return to the RBI whether this ratio has been maintained or not. And there are other particular part of this particular provision which talks about what if it is holiday, what if it is a public holiday. Okay, a detailed requirement is there which is required to be basically followed with respect to this one. So again, SLR requirements comes from the section 24 of the Banking Regulation Act, and 18% is the current one that we are required to, the bank is required to maintain. Current rate. Clear? So this is how you will audit the CRR and SLR portion. Any doubt? No? Okay. Now we have seen two important parts: advances and the prudential regulation with those advances. And the second thing we saw was with respect to your SLR and CRR part. If you are required to report on these things, then what procedures you as an auditor will perform and how you will perform and what you will do. But there are other areas also in a bank which are more important, which are also very crucial that as an auditor we are required to look into those areas. Okay, for example, investment. Investment is one such area where, as an auditor, we are required to look into how the investments are made and what are the investment made. And, again, there are requirements of the prudential regulations with respect to the valuation of the investments. Okay, how the investments are valued, basically, whether it's a specific security, whether those are the things. So, as an investment, if I talk about, we as an auditor, we will first see from the audit report that what we are required to report on investments. So let's go to the investment area. Yeah, this is the investment area where auditor is required to report. And what is he required to report? First thing auditor requires to report is in respect of the purchase and sale of the investment, whether appropriate authority was delegated to the branch, okay, who acted for purchasing and selling the security. See, banks have the money with them. Banks have all the money with them. But the question comes is, when it comes to the investment, not providing the loans, not providing the advances, but using that money for the purpose of investment, whether those investments are which are purchased by the bank or by the branch, because this decision either is taken in the branch level or the head office level. Then in that case, whether these investments are appropriately approved or whether the branch had an authority or appropriate level of authority to purchase such investments. Second, whether the investment which are held by the branch, whether they held in their own account or whether they are held on behalf of the head office or other branches. So in whose account they are holding that particular investment? Is there in, like, when I say in their own account, you can say in their name. So is it in their name and account of the branch, or is it in the name and account of the head office or other branches of the same bank? And whether they are available for the physical verification. Because what happens is, a lot of times when these investments are there, okay, so before verifying the investment, as an auditor, we are required to verify, let's say bank has invested in scripts, shares. So whether physical documents for that particular transaction is available, broker receipts or trade receipts are available or not. And if these investments are held in the public debt office, okay, then whether is there any custodian over there, or is there any particular kind of a centralized system where I can see that investment, or I can go and verify that particular investment that is purchased in the name of bank. It should not happen that everything is running on the bank receipt BR. And the frauds have happened in the past where bank was given a BR from the brokers saying that you have the investment in your name, but it was not there. So there is an e-cobate system for government securities. Basically, banks are allowed to hold government securities. They are not allowed to hold, invest in other securities subject to certain terms and conditions. But let's say in government securities also, is there any centralized place? So yes, there is a centralized place called e-cobate. E-cobate is a platform where bank can see what basically is held in the name of bank. Okay, what is held in the name of bank, and what is basically is appearing in the name of bank as a securities that they have purchased. Then once you go and you check, then you should have the whether if let's say for example, if the investment is there with the counterparty banks, investment is not with you but with the other banks, you can use SA 505 procedures. What is SA 505 procedures?
External confirmation.
Yes, external confirmation. So you can use external confirmation procedures to verify whether the investment which is lying with the other banks or other counterparty banks, whether they are confirming in the external confirmation that the investment is there. Physical verification, basically, when you are not able to do, then you should obtain an external confirmation and perform the conciliation. You should see in whose name the securities are held, who are the nominees and all those things. So by this way, you can verify whether the security or the investment physically exists or not. Now there's a question. Is a branch separate legal entity? See, it's not about being a separate legal entity, but it's all about having an account. Let's say, for example, branch is maintaining an account somewhere, because the accounts with respect to the investment, with respect to the cash and everything are the branch level. So it may happen that the investment is there in the name of branch with the counter bank lying in their account. So accordingly, you need to see whether it's in the name of branch or it's in the name of the head office. Okay. Then comes the very important part, is valuation of investments as per the RBI guidelines. Now that's very critical. Valuation of investments. Now, can anyone tell me how do you value the investments? Normally, for a company, how do you value the investments? Anyone? How do you value the investments? Come on, guys, quickly.
Initially at cost.
Initially at cost, then okay. And what you do at the year end for the investments? Anyone? What do you do at the year end? Quickly, guys. No? Okay. See, valuation of an investment. There are multiple type of investment that the bank does. Cost or fair market value. Yeah. Okay. So there are multiple type of investment that the bank does. Okay. I will show you a particular regulation. Again, there are, you can see different areas are covered by the different regulations. So for each area you will find a different regulation. That is a normal practice because banks are heavily regulated, and we will see one such regulation for the commercial banks. And this particular regulation for the commercial banks is based on the valuation, classification, and operational of investment portfolios for the commercial banks. And we will see some examples in that to understand how it works. So again, these are the regulations. They are updated as of 1st April, but 20th November, everything changed, which is not applicable to you. Okay. So basically, when I talk about this particular directions, these are applicable to all banking companies. Okay. And what it says that bank shall undertake investment activity as per the terms and conditions specified in this direction. And for that, first of all, bank shall adopt a comprehensive investment policy. So first of all, banks are required to draft a comprehensive investment policy, which is approved by the board of directors. And then this policy should provide that what is investment criteria, what are the securities in which investment can be made by the bank, derivatives in which bank shall deal, authority to put through the deals, like who will be authorized to carry out the deals, procedure for obtaining the sanction of appropriate authority, all those things are there. Okay. And if I talk about certain categorization of investments, see, categorization of investments for the banks are basically into three categories. One is a held to maturity, one is a available for sale, and the third category is fair value through profit and loss account. Now, when I talk about held for trading, okay, held for trading is a subcategory of fair value through profit and loss account, which is part like, you are holding that investment for the trading purpose. That's why it is fair valued through P&L. And these all the three type of securities are valued in a different way. So you need to understand which kind of security it is. And this is excluding secure investment in basically in subsidiaries, joint venture and associate. That's a different story. Investment in subsidiary, joint venture, associate, different story. But these held to maturity, available for sale, and fair value through profit and loss account, which includes held for trading, are the three important categories for the investments. Okay. Now again, banks are required to present their investment in the following format in their balance sheet. So when we talk about the balance sheet, you will see government securities, other approved securities, share, debenture, subsidiaries, and others. So for example, let's go to the bank's financial statement. We already have with us. We will now go to the investment part. This is Schedule 8 investment, which is government securities, other approved securities, share, debentures, subsidiaries, others. Everything here. In India, outside India. Okay. Now, there are other reporting requirements on investment that I will show you. Now, these reporting requirements are over and above the schedules you have as per the Banking Regulation Act, for your basically financial statement. See, Let me rotate it for you. Okay. So this is the composition of investment portfolio which is included in your FS, which includes held to maturity, a distinct category. Again, into different categories: government securities, other approved securities, shares, debentures, subsidiary, others in India, outside India, which is sub again divided into held for maturity, available for sale, fair value through profit and loss account, non-HFT, and HFT held for trading, a separate category. Coming to your total securities or total investment basically. So investments are required to be classified in these categories. Now, as an auditor, we are required to be, we are required to understand that how to classify securities in this particular bucket. Then only you will be able to audit. So which security should go into the held for maturity, held to maturity, which should go for available for sale, which should go for fair value, which should go for held for trading, all these things. Then only we will be able to identify, okay, the classification is correct or not. And for that, we have the regulations in place. So regulation says that basically which are the securities which are held for maturity, the objective of holding it to the maturity. Okay, financial assets held with an objective to collect the contractual cash flow on them. Then again, they will provide what is a tier 1, additional tier 1, tier 2, a lot of things are there in specifying that. AFS, second category, available for sale. Securities acquired with an objective that is achieved by both collecting contractual cash flow and selling securities. Contractual terms of the security meets the SPPI criteria, which is given again in this regulation itself. So those are required to be classified as in available for sale. Then fair value through profit and loss account. And they do not qualify, like securities that do not qualify for held to maturity, or available for sale shall be classified under these particular category. Like which is equity shares, investment in mutual funds, AIF, REITs, then investment in securitization notes, bond debentures, all those things. Okay. Again, security referred in 6.1 and all those things. And then you have a subcategory of HFT, that is held for trading. Again, there is a requirement in this particular regulation which are required to be classified as held for trading. So, as an auditor, basically what we are required to do, we are required to understand whether this classification is appropriate or not. Okay, whether this classification is as per the regulation or not. And on the basis of that, we are required to basically, okay, report on whether this even reporting done in the financial statement is appropriate or not. So basically, when we talk about the investments, okay, we need to understand how to value. And again, when I talk about valuation, now we will come to the valuation part. We will first talk, we were talking about categorization. After categorization, there is a requirement for the valuation. How these are required to be valued. Okay. When we purchase initial recognition, or when basically you subsequently want to measure it. So there are initial recognition criteria, and there's a subsequent measurement criteria. For example, HTM shall be carried at cost, shall not be marked to market. M2M is not to be recognized after initial recognition. Okay, if there is any discount or premium on securities on held to maturity, is required to be amortized over the remaining life of the instrument. Now, when I talk about AFS are required to be fair valued at least on the quarterly basis, or if not on more frequently. Okay, again, these are the other requirements. When I talk about fair value through profit and loss account, they are required to be fair valued, and the net gain or loss arising such valuation is required to be credited or debited to the profit and loss account. Now, securities which are classified held for trading under the subcategory, which is the subcategory of fair value through profit and loss account, are required to be valued on a daily basis. And whereas other securities, which I'm talking about, these one, other than the held for trading, these are required to be fair valued at least on a quarterly basis, but not on a more frequent basis. So at least quarterly basis, you should value them. Okay, fair value them, and held for trading on a daily basis. So this is how we are required to value the securities, or we are required to value the investment for a particular bank. And whatever gain loss is arising, we are required to book into the P&L account, and we are required to book into the relevant accounts which are given. Now, what if there is a reclassification between the categories? Do you think is it allowed? For a particular quarter, I classified a security as a held for trading, held to maturity, and then suddenly I classified as a available for sale.
Yes, sir. When there is a change in modification, when the management is decision changed from held to maturity to available for sale, like that, if the decision is changed on those cases, the valuation also will ultimately will change it.
Yes, absolutely correct. So first of all, you cannot, on a discretionary basis, change the classification unless and until there is an approval from the board of directors. And reclassification also requires a prior approval from the Department of Supervision of RBI. So you cannot directly change anything, basically, without the approvals. For the approvals, you need, for the reclassification, you need an approval of the board of directors and Department of Supervision of RBI. Let's say you obtain the approval. In that case, reclassification should be done prospectively from the date of reclassification. Do not go retrospectively. And plus, if there is a reclassification, then what is required to be done? Let's say from HTM to AFS or FVTPL, then what is required to be done? For example, fair value measured at the reclassification date shall be revised carrying value, or any gain or loss arising from a difference, okay, between the revised carrying value and the previous carrying value shall be recognized as the AFS reserve. Similarly, in FVTPL, the difference arising shall be recognized in the profit and loss account on profit on revaluation of investment under Schedule 14 other income. So this is how, like, again, it is given AFS to HTM, or FVTPL, or if it is a FVTPL, then HTM to AFS. So how you are required to basically, do the accounting treatment, it is given in the regulation. And as an auditor, we should be aware that whether this particular treatment is followed appropriately or not. So if I just show you, if you see, everywhere you will see unrealized gain. Now this is held to maturity. There is an unrealized gain and provision for non-performing investment. Provision for non-performing investment. Unrealized gain, provision for non-performing. Unrealized gain and provision for non-performing. Unrealized gain and provision for non-performing. So these are the adjustments which are already there. So as an auditor, we should be aware whether these adjustments are appropriate or not. Whether the bank is allowed to perform these adjustments, or whether they are in line with the directions which are issued by the RBI. Clear? Any doubt till now? Again, there is a sale. When you sell a particular held to maturity, when you do a fair valuation, there are operational guidelines. There are non-SLR securities which are not held for the purpose of SLR, because there are securities which you held for the purpose of SLR also. Okay, then in that case, how those securities are required to be done? So one such example is, see this one. disclosure in respect of non-SLR related investment, non-performing non-SLR investments, issuer composition of non-SLR investments. So these are non-SLR investment, means these are not done for the purpose of SLR. This is other than the SLR purpose investments. Again, as I said, sale made out of held to maturity. If there is any sale made out of held to maturity, you are required to report on them. So all these reporting requirements are followed behind the investment category. Investment asset which is held by the bank. Banks are required to have internal controls on the investment. Again, that is part of the regulation. Regulation specifically says that what kind of internal control bank should have on the investment category or investment assets. So if I just show you, this is internal control system, that it should at minimum, this is at minimum which is specified by the bank in respect of investment transaction, which should clearly specify which is a trading, which is settlement, monitoring and control and accounting related transaction. Then daily slips shall be prepared for every transaction entered into, deal slips. Okay, whether it is the HTM, AFS, FVTPL or HTF. Then for bank shall have a separate functions for these investment. So functional separation for these trading and back office functions for bank's own investment accounts. But then there should be a periodic reconciliation of the investment book at least quarterly. So these are certain internal controls. Again, there are many. I'll not go into all those details. But these are certain internal controls that banks are required to keep in place. And as an auditor, we are required to validate these internal controls. Plus, there is a entity level control that the bank's management should ensure that there is adequate internal control and audit procedures for proper compliance of the instructions in regard to investment portfolio. So, audit procedures. Plus, as an auditor, we are already required to report into this. The banks shall get a compliance in the key areas certified by their statutory auditors and furnish audit certificate to the DOS to RBI on the investment area. So, auditors are required to issue a certificate, and you can only issue a certificate when you know what are the requirements. So, this is how basically you will evaluate the internal control, you will evaluate the regulations, and this is how you will understand and audit the investment area. There are multiple things, but this is one of the things. Plus, there is an additional reporting requirement for the investment area. Okay, which is that banks are required to report half-yearly review. Banks are required to provide a half-yearly review. Okay, with respect to the investment area. And that is required to be placed before board within 2 months, like by the end of May and by the end of November, which should cover the operational aspect, major irregularities observed in the or audit reports, all these things. A copy of half-yearly review report is required to be submitted to the RBI also by June 15th or December 15th. Then treasury transactions are required to be separately audited under concurrent audit and internal auditors once every month. And the results are required to be placed once every month before the chief executive of the bank. Then there is another internal audit requirement with respect to the transactions in securities. So internal audit shall cover the transactions in securities on an ongoing basis. Plus, if there is any business done by the brokers through bank is doing any business or investment through brokers, then that shall be audited by the concurrent auditors who are auditing the treasury operations. And that should be included in the monthly report. the audit committee of the bank is required to review these particular reports and meetings on a frequent basis. Again, these are some requirements with respect to the reporting and the audit part of the investment. Plus, there is a requirement with respect to non-performing investment. The way we have seen non-performing asset, similarly, there is a non-performing investment also. The prudential norms that we have seen, income recognition and asset classification pertaining to advances, they should also be used to classify non-performing investment. Means the 90-day criteria based on which we were classifying NPA, we now can also use that criteria to classify a non-performing investment. Okay, means in respect of debt instrument, if interest or installment is remaining due or unpaid for more than 90 days, it will become NPI. If a fixed dividend is not paid for more than 90 days, it will become NPI. Okay, so for each and every category of investment, you need to see whether this investment is an NPI or not. And if you say that this investment is the NPI, in that case, simple. Bank shall not accrue any income on the NPIs. Incomes are required to be recognized on realization. And if there is any M2M, mark to market appreciation for these investment, that is also required to be informed. Plus, there is a provisional requirement. You are required to create the provision on these investments. The way we have seen in case of a non-performing asset, similarly, you need to impair the investment by creating the provisions, which is recognized in the profit and loss account. Again, the provision requirement based on the category that we have seen, substandard, doubtful, and loss asset. Similarly, substandard, doubtful, and the loss investment. Okay. Then, apart from that, if there is any investment in the central government and state government, it should not be classified as the NPA. Okay, investment in the central and state government shall not be classified as an NPA because it is never going to be non-performing. If there is a central government guarantee securities, that also not required to be classified as an NPA, unless the guarantee has been repudiated when invoked. But banks are required to continue to recognize M2M gains and losses and AFS reserves on profit and loss account for these investments. But income only to be recognized on realization basis. So, in case of the non-performing asset also, it will be NPA. It will not be NPA, but income is only to be recognized on realization basis. So for the income purpose, I will count that particular asset as an NPA. For the classification and provision, I will not count as an NPA. Clear? Again, you might have seen investment fluctuation reserve you might have heard about the banks are required to create investment fluctuation reserves at a 2% level. That is also part of the regulations. That there should be a IFR should be created at least 2% of the AFS and FVTPL on continuous basis. So again, these are the requirements with respect to the investment. And then as an auditor, we are required to look into these particular requirements, whether they are met or not, whether they are basically adhered by the bank or not. Clear? Any doubt? So let's come to the study material 14.28. with respect to the investment. So we talked about the policy which is required to be approved by the board. It should clearly outline the objectives and all those things. Separate function for the investments, reconciliations that we saw. Okay, documentation. We saw physical verification. We discussed the requirement for the physical verification. Okay. Then classification, HMT, HFT, AFS in detail. Then if there is a shifting of investment from one category to another, it should be approved by the board of directors plus Department of Supervision, RBI, plus there is an accounting treatment on that. Valuation part, we saw valuation part, how they are required to be valued. Initial valuation, subsequent valuation. We saw the NPI, non-performing investment, the same requirement that we apply for the NPA, that is income recognition. It was just a minute. That word. Sorry. Yeah. Yeah. Income recognition, asset classification, provision and provisioning, IRACP. Okay. So these are certain prudential regulations basically that we saw that are required to be applied for the investment also. That is 90-day criteria for NPA and NPI. Again, you need to verify whether income is accounted appropriately. So if it is NPI, then only realization basis. Whether profit and loss on sale of investment has been computed appropriately, proper system for recording and maintenance of TDS certificate, and adequate disclosure in change of method of valuation. We saw that. Then dealing in security on behalf of others. When I say, remember we discussed, if the investment is held with someone else or if the investment is held for someone else. Okay. And there are special purpose certificate relating to the investment. If there is any, then in that case, that is also required to be reported. Now, this is how you are required to perform the audit procedures on investment. Any questions? So there is one. Is there any specific definition of asset and investment? Yes. So if you see at the start itself, we discussed the definition of investments. What are investment and which investment will be included in this? So let me go on the top again. See, these are the categorization of investment, which will be government securities, other approved securities, shares, debenture bonds, subsidiaries, joint ventures, and others, which are again then classified into HTM, objective to hold for long term, and all those things. When I talk about asset, these are the advances. Basically, when I talk about asset, non-performing asset, or it is basically the non-performing advances that are held by the bank. So over there, it's the kind of advances which is there. And again, for the classification of these advances or the assets, I'll show you something. See, the definition of NPA, non-performing asset, talks about is a loan or an advance. So NPA, non-performing asset, includes a loan or advance. So the definition of NPA says that what kind of asset it is. It is a loan or advance, which is part of the NPA. Now, whatever loans and advances are provided by bank, everything will be part of this. I hope I'm clear. Any doubt? Any doubt? Okay. So if no doubts, what we do is let's take a quick 10-minute break. After the break, we'll come back and continue for the other areas. Okay, there is one more or two more areas that I want to take on to specifically. Okay, so let's take a quick 10-minute break and come. Let's come. Yeah. Okay. Thank you. Welcome back. Let's continue the session. So we will continue with one question, and not one question. Two. We will take two questions, different questions. Okay. So let's go to the question and let's read the question. I'll read the question for you. Okay.
MS, JKL and Co. are the statutory branch auditors of the City Main Branch of Prosper Bank Limited for the year ended 31st March 2024. While verifying the advances portfolio, the audit team scrutinized the cash credit account of MS, Fabricators and Co., which has a sanctioned limit of 100 lakhs rupees. The outstanding balance in the account as of 31st March 2024 is 95 lakhs rupees. The auditor observes the following. The borrower has not submitted the stock statements for the months of January, February, and March 2024. The drawing power, DP, is currently being calculated in the system based on the stock statement of December 2023. A stock audit was conducted by an external firm in December 2023, which reported that a significant portion of the stock was obsolete. Based on the stock audit report, the actual drawing power should have been reduced to 80 lakhs rupees. The branch manager explains that since the outstanding balance, 95 lakhs rupees, is well within the sanctioned limit, 100 lakhs rupees, the account is standard and regular. He further argues that the non-submission of recent stock statements is a temporary deficiency and should be ignored.
So, you as a statutory branch auditor evaluate the branch manager's contention and decide the classification of the account with reference to the guidelines that we just now saw. Take a minute, read the question again, and then try to answer. Take a minute, read the question, and then try to answer. Okay, now tell me, what do you think? In this particular scenario, whether the branch manager is correct?
No, sir, it's not correct, sir.
And any specific reason?
There are two reasons actually is here. The stock statement for non-submission of stock statement more than 3 months, which will be turned into NPA. Point number one. Point number two, the stock audit done December 2023, and the stock value, and according to that, the drawing power is set to be 80 lakhs only. Now the outstanding of loan is 95 lakhs. It's more than the drawing power, which also is out of order for more than 3 months. And in that case also it will be classified as NPA. The sanction limit is 100 lakhs is not matter. What is the outstanding? What is the actual drawing power is the matter. On the second case, both case it will be classified as a NPA in this category. what the branch manager contention is not correct.
Okay. Yes, absolutely correct. Very good. So basically, in this particular scenario, what is happening is there was a loan. Okay. This particular loan, this particular facility in the current given scenario, okay, was based on the December 2023 stock statements. This cash credit facility was based on the December 2023 stock statement, and we are standing in the 31st March 24. Already January, February, March, 3 months have passed by. We don't have a updated stock statement. So the drawing power cannot be calculated on the stock statement, which is 3 months more or older or more. Now, audit was conducted in December 23. Based on that, there was a significant portion of the stock which was absolute. And because of that, the drawing power should have been reduced to 80 lakhs. Means since December 23, we were aware that the drawing power should have been 80 lakhs, but it was not revised. The outstanding balance is 95. Agreed. Sanction limit is 100. But the sanction limit is also based on the stock statement, which is older than 3 months. As a result, in this particular scenario, we would not say this is an temporary deficiency. This has been irregular. Yes, I agree. This is an irregular, but irregular for more than 3 months. Temporary deficiencies are kind of deficiencies where, okay, this is an NPA just because non-renewal of the limits or there is something, the account has been irregular. But if it is irregular for the period of 90 days, okay, it has to be classified as an NPA. I cannot say that, okay, just because of the drawing power is not calculated or stock statement is not submitted, it is a temporary deficiency. No. So in this particular scenario, age of the stock statement is a problem, which is more than 3 months. Audit adverse findings, which is saying that the valuation of securities is not appropriate, is also a problem. Plus temporary deficiencies. If there is a temporary deficiency also for more than 90 days, I will classify that as an NP. In this scenario, all the 3 things are there. As a result, instead of saying this as a temporary deficiency, I will classify this particular account as an NPA. Clear? Any doubt? See, again, as I said, if when we were talking about the drawing power, what we discussed is, I'll just take you back to that particular provision. What we discussed over that particular time is that if there is a calculation pending, okay, if there is a calculation pending basically because of non-availability of stock statement, that can be classified as a temporary deficiency because the calculation is pending just because of non-availability of the documents which are there. But in that case also, there is a limit given. Okay, the limit is that drawing power should not be, like the statements which are relied, should not be older than 3 months. Okay, they should not be older than 3 months. If it is older than 3 months, would be deemed as an irregular. A working capital account will become NPA if such irregular drawings are permitted for a continuous period of 90 days. Now, why I'm saying it is irregular? Because here my this drawing power is determined on the stock statement, which is 3 months or older. So it is irregular January, February, March, since 3 months. And once the irregularity is for the continuous period of 90 days, it becomes an NPA. If it was a regular or ad hoc limit, then in that case, again, in that case scenario also, it is 3 months. It should not be more than 3 months. I have to regularize within 3 months. In certain cases, yes, I can extend to 6 months, but not beyond that. But over in that scenario also, I need to show that, okay, it was non-availability of the financial statements and other data from the borrower. Okay, and evidence is required for that to increase till up to 180 days, but not beyond anything 180 days. Clear? So in the current scenario, basically, what will happen is this particular cash credit is based on the stock statement of 23, 3 months older. It's irregular, and for the period of 90 days, if it is irregular, it will become your, we can say, NPA. Number two, a stock audit was conducted. We already know the drawing power should be 80. We already know the drawing power should be 80. So from 80 to 95, it is already more in excess, again for 3 months. It's an NPA. It's not a temporary deficiency. No, it's an NPA. Clear? Any doubt? Any doubt? Okay. If no doubts, let's go to one more question. Very important question. Again, this is kind of the that we discussed just now with respect to the topic of investment. It is on that particular topic. Okay. Let me read for you.
MS, GHT and Co. are the statutory central auditors of Secure Bank Limited for the financial year ended 31st March 2024. During the audit of the investment portfolio, the engagement partner, CAG, scrutinized the holdings in state government bonds and corporate debentures. The auditor noted the following regarding a specific holding in MS Sunrise Power Limited debentures. Status: the bank holds debentures worth 10 crores rupees. The interest on these debentures has remained in arrears and unpaid for 105 days as of the balance sheet date. Bank's accounting: the bank has continued to recognize interest income on these debentures on an accrual basis. Valuation: the bank has carried these investments at their book value without creating any provision for depreciation, arguing that the default is temporary and the company has promised to clear dues shortly. Required: as the statutory central auditor, evaluate the appropriateness of the bank's accounting treatment regarding income recognition and valuation of these securities with reference to the RBI prudential guidelines.
Basically, in this particular scenario, there is a debenture worth of 10 crores, arrears and unpaid for 105 days. Accounting valuation is given. Read the question for a minute and then tell me whether this is appropriate or not. So tell me whether this is appropriate, yes or no?
No, sir. Bank is not appropriate.
Okay, bank is not appropriate. What should be the treatment over here? Very good, Ayush. What should be the treatment over here?
Sir, on the two cases, the on the status, if that investment is due greater than 90 days, which means here the interest, the debenture interest is not served, remain arrear for more
Hmm.
than 90 days. So
Hmm.
in that case, it will be classified as a non-performing investment.
Yes, very good.
That is not done over here. On the second
Hmm.
part of it, the bank accounting, the interest, whatever the income they're going to, it's accrual basis. It is not be the
Hmm.
accrual basis when the investment is classified as NPA. It has to be provided on the cash basis only. That is also incorrect.
Very good. Yes.
And
So in
and
this particular, yeah.
and the valuation also, in this case, valuation also they have to do as per the provisioning to be done as per the prudential norms in this case.
Yes, absolutely correct. Very good, Sanjay. Very good, Ayush, and very good, Sarah. So this is absolutely correct answer. Swaminathan, you are given. So what is required to be done here? We are required to apply the prudential guidelines, prudential norms. Okay. Income recognition, classification of assets, and the provision guidelines that we have seen. These guidelines specifically say anything beyond 90 days, outstanding, overdue 90 days, for asset, it will become a non-performing asset. But for the liability, it will be non-performing liability. Oh, sorry, non-performing investment. For investment, it will be non-performing investment. My bad. Not liability, investment. Okay. So for investment, it will become a non-performing investment because it is overdue. I have not received the interest on these debentures for a period of more than 90 days. Now, when I say it's an NPI, income is not required to be recognized on accrual basis, rather on a realized basis. So here also bank is incorrect. Valuation. The valuation is carried without creating any provision. Now, as of now, in this particular question, I have not provided the category of the investment. For example, held to maturity, AFS, FETPL, or held for trading, whatever it is. So I have not provided those categories over here in this particular question. But here the valuation is coming on the part of the provision. When I talk about valuation, it's a provision. And the bank is saying it because it's the temporary in the nature, no required to make the provision. That is wrong. This will fall under the category of which asset? This will fall under the category of
Substandard asset, substandard investment.
just like, yeah, substandard asset. So substandard asset or substandard investment is in that particular category. And what is the provision requirement under that category?
I think for held to maturity, it's 15%.
Okay.
For others, I don't know, sir. Only that for the held to maturity, I remember. I read somewhere.
So yeah, the general is also 15%. If you see, remember in the last session we discussed, if there is a substandard asset, the general provision is 15. If there is an unsecured portion, okay, additional provision is also required on that 10%. Now, if it is escrow account, then I may go for a 20% lesser provision. But usual general provision is 15%. I will go with that only in this scenario. So the general provision in this scenario that should be applicable should be 15%. Okay. But if you want, we can, because we don't have the categorization of the investment, you can only say the provision is required to be made instead of quoting the exact provision. Or you may also, assume, okay, this is belonging to this category. So this is the provision that is required to be made. So bank is incorrect. Provision is necessary either at the rate 15% or if any specific category, then for on that particular percentage. Clear? Any doubt? Yes, no.
Yes, sir. Clear, sir.
Okay. Now I will take up one important topic. Why? Because this is relevant in today's time. Okay, a lot of basically you can say focus is there in this particular topic gradually. Okay, now what is the topic? Basically it's about the restructuring and how prudential norms are applicable on the restructuring part. Let me go to the prudential norms. So many files. Okay. Prudential norms applicability on the restructuring. Now, first of all, the prudential norms that we are talking about, they have provided what is the definition of restructuring. Okay. They have given what definition means, what is restructuring, what actually it means. Okay. And when we say a restructuring, as per the definition, it is an act which a lender, for any economic reasons, and it could be because of the borrower's financial difficulty, grant concessions to the borrower. Okay, grant concessions to the borrower, and it may include modification of terms of advances, securities, okay, or alteration of payment period, payable amount, amount of installment, rate of interest, rollover of the credit facilities, or may sanction additional credit facilities, okay, and may release additional funds for an account in default, okay, or enhancement of the existing credit limits, compromise, settlement, all these things are there. Okay, so this is the definition of the restructuring. Now, why this is important? Because we need to understand where this concept is required to be applied. We cannot apply this concept everywhere. This concept of restructuring cannot be applied everywhere. It has to be specific restructuring only, then only we will apply these prudential norms in this particular scenario. Okay. Now, what is the requirement for the restructuring? What banks are required to do? Now, there is we have already seen there is an early warning system, SMA 1, SMA 2, SMA 3. But beyond that early warning, beyond that NPA classifications, beyond that provisioning requirement, there is a policies on the resolution of the stressed asset. That means if there is an asset which is kind of on the verge of getting falling into the default category, or may fall into the default category because of the stress and the financial difficulties. So banks usually have a board approved policies for these lenders, where they kind of provides facilities to the stressed asset from to like if there is a temporary financial difficulty, then that may help them, and based on the various qualitative factors, okay, not to everyone, but based on some qualitative factors, okay, so that the person or the particular borrower can use that facility and reduce the financial burden and bring the stability, and then that particular asset will not become an NPA. So a facility given to reduce the financial burden. Okay. Now, but in this particular case, there are some requirements that when a particular asset is required to be calculated or taken as a stressed asset, or which are the borrowers to whom this kind of facility is required to be extended. Okay. These are additional norms on that particular part. But beyond that, there are the norms with respect to the classification of these assets. If there is a restructuring happening, then how would I classify? Well, as I said, it is on the verge of becoming NPA. It has not become the NPA. There is an indicator that there is a financial difficulty. The borrower is still not in default, but will become defaulter in the foreseeable future because of the whatever financial difficulties are there. For example, let's say there were debt securities which were immediately delisted, and the borrower now has to like it has gone to immediate maturity. The bonds are required to be paid immediately at a full amount. That is going to impact the borrower in a very big case. There are credit facilities given to the borrowers which are on the verge of becoming non-performing. So now they are on the verge of becoming non-performing. Or either, let's say, for example, in certain scenarios, they might be already non-performing, substandard. So in that case, how we have to classify the particular asset? So the first question is, if let's say there is a stressed asset, okay, and a restructuring is done. So now let's say there is a stressed asset and the restructuring is done. In that case, let's say for example, the earlier classification, there was no default as of now. Earlier classification was standard. The borrower was facing financial difficulties, okay, and the borrower came to the bank, see, I'm not able to generate the funds to pay this, and I see that in the future I am going to default it. So you give me additional loan, you restructure my existing loan, so that the financial burden can get reduced and I can pay small amounts, and work on that particular payment part. Bank said, okay, fine, restructuring done. We agreed to a revised payment schedule with a additional 6 months of moratorium period that we are giving to you. How will you classify this standard asset now? This was a standard asset, a restructuring done. How will you classify this?
I'm not sure, sir, but I go for with the standard asset again.
Okay. So you will go for the standard asset again. Anyone else? Anyone? What do you think? What should happen with this account? Okay.
In CARO 2020 also we have similar provision in class number 3. Specifically talks about NBFC. When there is a restructure is done, that particular point is not applicable for them.
Okay. Yep. So in this particular scenario, if this was a standard asset, immediately I have to classify that this asset as an NPA. If there is a restructuring, on restructuring, this asset will be immediately classified as an NPA and the new category will be substandard asset. New category will be substandard asset. Okay. So for the stressed asset in the restructuring, immediate categorization will change to the substandard and it will go to a NPA category. Now let's say for example, it was the substandard. So default was there, NPA was there for more than 90 days. And after making the default, the person came for the help with the bank and bank accepted the resolution for the restructuring. So a restructuring was done for the substandard asset. Now what category you will do? Give after the restructuring. Same for the doubtful. What category you will now give for the doubtful if it was earlier doubtful? Anyone?
No idea, sir.
In that particular case, it will remain the same because already they are NPA. You cannot just go from substandard to doubtful. It's already an NPA. So it will be same. No change. Okay. Now, the moment I make this particular asset as a substandard, in case of standard to substandard, I need to look for provisions. Yes or no? I need to look for the provisions. Now, there is something basically upgradation of a particular asset. Okay. Now, from the standard to NPA, and NPA will retain the same. I can only upgrade back from NPA to standard when the entire loan has been paid off. When the entire loan, outstanding loan in the facility has been paid off and it is showing satisfactory performance. And again, what is satisfactory performance? There is a basically what you can say criteria for that. Either it is showing satisfactory performance or all the outstanding loan has been paid off. Okay.
Okay, sir. Here the only standard only will move to substandard. For other category, substandard will remain substandard. Doubtful remain substandard on the restructuring.
Yes.
Okay.
And when I say basically this satisfactory performance, it is a 12 months. So for 12 months, I will see that whether the restructuring, which is known as a monitoring period. So for this 12 months or monitoring period, I will see whether that person is able to pay the amount or not. Now, if he is not able to pay the amount, then I will make additional 15% provision on these assets. Additional 15% provision on these assets. Okay. So, for example, for this substandard asset, 1 year I will give as a monitoring. And if satisfactory performance, that is debt more than equal to 10% is paid of outstanding amount on all the accounts or entirely paid. Okay. If debt more than equal to 10% is paid during that 1 year, in that case, fine. I can either choose to keep same category. If still it is stressed and the qualitative frameworks are there and all the things are there, or upgradation is available. Again, subject to terms and conditions. We will not go to TNCs now. But what if there is no satisfactory performance? No satisfactory performance. Even after the restructuring, he has made a default. Simple. Additional provision of 15% I will apply. Additional provision of 15% will be applied for this kind of asset. This is as per the other this is in addition to the other provisions. And whatever other provisions are there, this is additional. Clear? Any doubt? Can the category change during the monitoring period before the results? See, no, you can change the category if it is paid entirely. But if it's not paid entirely, then you have to wait for the monitoring period.
Like,
Or
can it be
let's say,
demoted?
Can
it be demoted from substandard to doubtful?
See, it is already NPA. So in that case, I have to wait for the period. If it has completed 12 months of the NPA, I'll categorize as a doubtful.
Okay, so let's say it is in between of the restructuring, and the duration of our review is, let's say, 6 months has passed, and in between that period the NPA category has changed. Like, it was earlier substandard and now it has been more than 12 months in substandard, so it will automatically be demoted to doubtful asset.
Yes.
Okay, and after the results, we will see if it is satisfactory, then we can promote it to substandard or standard, as the case may be.
Yes.
Okay, sir. Thank you.
Sir, here I have one more question.
Hmm.
If it is satisfactory, performance debt is equal to or greater than 10% is paid, the same category will be there. Same category. This substandard means you will continuously substandard. On what situation the substandard asset will move to standard asset, sir? Bringing back to original condition.
So if there is a satisfactory performance, then you will bring from substandard to standard. If there is a satisfactory performance during the period or monitoring period, you will upgrade the account from substandard to standard.
Okay. Why I ask this question, sir? You put the two branches upon the satisfactory performance, the same category, and another category is that upgradation is available subject to terms and condition. So, why it was the same category, even though it is paid more than
Reason
10%?
because I'll tell you why same category. Reason because there are other conditions also when we evaluate the satisfactory performance. It's not only about the payment, okay, but if there are any qualitative aspects which are there, for example, the rating is still not investment grade rating on that particular asset. Okay, it is beyond. It is like like one of the worst rating which is still there. If there the asset is there which you already have a indication that it is restructuring, or I say, let's say for example, application under the IBC or something like that is going to happen, a dispute is happening because of which you are thinking particular application will be filed or resolution will be there under the IBC, something like that. You have the indications. In that scenario, it will not be appropriate to classify back to standard because there are qualitative factors present which are pointing otherwise.
Okay, sir. Since it is categorized as a restructured account, it's needed for the further review and what is the credit summation, what is the business activities, whether all the money returned to this account, all these things. They will wait for some time. It may need further review and approval to move
Yes.
into normal category. Okay.
Yes. Let's say,
Got
for
it.
example, there are high value loans beyond 100 crores, beyond 500 crores. Now, if there is a beyond 100 crore loan which was restructured, definitely over there, there is a requirement that you should need at least investment grade credit rating or better, okay, from the credit rating agency. Now, for that particular for that particular borrower. Now, let's say, for example, if the aggregate exposure to that particular person is more than 500 crores, the requirement is that you need two rating instead of one ratings. From two credit rating agencies, you need above than the investment grade or above than that. Then only you can upgrade. So,
Yes, sir.
and for different kind of lenders, there is a, like the way I gave you the 10% requirement. For different kind of lenders, there is a more requirement. For example, already a lender is into the IBC. So over there, the review period is different. The percentage requirement may increase to 15 to 20%. That depends upon the type of category of the borrower. So that's why, subject to terms and conditions. As of now, basically, I have just given the standard one, and there is we are not required to go in much more detail of that. Okay, but this is a standard one, and based on that, the provisions will be made. Clear?
Yes, sir. Clear, sir.
Okay. Now, if this is clear, we will take a question on the same topic which was there in the recent exam, which was a last exam basically. A question was there in the last exam on this particular topic. Just a minute. Okay. It was 4A. Okay. Very good question. Now the question is, Messrs. TZ and Associates are appointed as the statutory branch auditors of the Delhi branch of ABC Bank Limited for the financial year 24-25. CAT is the engagement partner. Verifying the advances, he has obtained the list of advances outstanding as on 31st March 25. On sampling basis, he selected one account of Mr. X, who has borrowed 1 crore in the form of housing loan in year 21-22. The account was operating positively till 23-24. Since April 24, the account was often remaining overdue. On 1/10/24, Mr. X approached the branch and requested to increase the repayment period and reduce the rate of interest as he was facing some financial crunch due to sudden medical emergency in the family. On 1/11/24, the branch accepted the proposal of Mr. X, increased the repayment period, reduced the rate of interest. The branch classified the account of Mr. X as a standard asset as on 31/3/2025. CAT instructed the bank that to classify the account as a substandard as on 31/3/2025, as there is a change in the terms of repayment. CAT started to draft a memorandum of changes for the account of Mr. X to be submitted to the branch. The rate of provision for the secured portion of the substandard asset as prescribed by the board of ABC Limited is 20%, whereas the requirement of the IRAC norm is 15% for the secured portion. In this context, justify the classification instituted by CAT regarding the account, guide CAT in deciding the rate applied for the secured portion of substandard asset while finalizing the MOC. Now, I'll give you a minute to read the question again and then you answer first of all with the asset classification. Take a minute, read the question and then try to answer for the asset classification. Very good, Ayush. So what is the answer? Straightforward, I think.
Yes, sir. The asset classification done by the management bank is incorrect. It has to be moved since the account is restructured. It has to be moved within 1 year times. Already it is a standard asset. It has to be classified as a substandard asset.
Very good. It has to be classified as a substandard asset. We just now saw.
Yeah, just now, sir. And also the provision which talks about the substandard asset as per that IRAC is clearly given it's a 15%. The bank is provided 20%, which is incorrect for the secured portion. It has to be 15% only.
It has to be 15%. Okay. Anyone else with a different answer or something else to add? Anyone?
15% you said is the additional provisioning over and above the provisioning we are doing otherwise.
See, as of now in this particular question, they have not provided anything on the satisfactory performance. I'll not go on to that.
No, it is not relating to the additional provisions. It is a
Yeah,
normal provision. Normal provision 15% to be done as per the IRCA, that as per the norms. But they provided extra 20%. I don't know why. But I
we
can
know
restrict
that. That's the
onto.
question. That's the
Yeah,
main part.
yeah, that is what we can go with the IRCA, that is a regulatory norms. We can restrict to that.
Any other answers to this? No? So, now, with respect to this particular part, see, we all agree with respect to the classification, substandard, perfectly fine. Any doubt on that?
No, sir, that's very much clear.
Yeah, it's substandard.
Hmm?
Yeah, it is substandard.
Substandard, that is perfectly fine. Substandard, not an issue. Now, coming to the part where we are talking about provision. Okay. Yes, the IRACP provision says that 15%. Yes, it is right. The provision is 15%. Okay. Now, for example, this general provision we are talking about, 15%. Yes, not an issue in that. Totally agreed. But there is something else also that we discussed when we were discussing the provision requirement. We discussed something else. We discussed that these provisions are provided by the prudential regulations, prudential norms. Okay. Now, based on these particular requirements which are there, based on these categorizations, provisions is required to be made by the bank. But bank if want, they can have a different policy to make a higher provision. So if bank says that I want to make a higher provision, fine, make it higher provision. There is no issue in that. Because these provisions are at the minimum level. So the IRAC provisions are at minimum level. Bank can create their own policies on the provisions which can be more stringent. Okay. So banks can have their own policies where they can provide a different provisioning requirement which is more stringent. See, so additional provisions at higher rate. These regulatory norms represent the minimum requirement. Minimum. A bank may voluntarily make specific provision for advances at the rate which are higher than the rates prescribed under these regulations. And these higher rates shall be approved by the board of directors, consistently adopted from year to year. Okay, these are not required to be considered as a floating provision, but the fixed one that will be applicable over and above the minimum regulatory provisions of the NPA. That means the provision which is there in the bank policy, if that is more than the provisions which are provided in this category, fine. Go ahead, make that provision, apply that policy. Not only in the case of NPAs, but in the case of standard asset also. So the standard asset also, bank shall put a board approved policy for making provisions of standard assets at higher rate than the regulatory minimum. It is allowed. So in our question, we discuss, it was given that this is approved by the bank's board of the ABC Bank Limited, which is, it is prescribed by the board, which is 20% more than the minimum rate. In that case, that more than the minimum rate should be followed, not the 15%. As a result, classification substandard, provision 20%. Clear?
Yes, sir, very much clear, sir. I was a little bit dilemma to say that, but I thought of going with the norms. Okay, now it's a now you, as you shown in the provision is very much clear now.
So if you see the answer also, first of all, how to answer this question is you specify what is restructuring. Okay. Then, and what is requirement of restructuring of assets with respect to the classification. That when as per the prudential norms, if a restructuring of accounts happen from standard, it is required to be downgraded to substandard. And if it is NPA, it will remain the same category. Okay. Now, in this particular scenario, it was standard, but it has to be classified as a substandard. So, correct one is substandard. This is the analysis. This is the provision, analysis, and the conclusion. Similarly, with the percentage one. So, this percentage are the minimum provisioning requirements. Provision. This is the analysis. That in this case, IRAC norms is 15, whereas the bank is 20, which is more stringent. Since IRAC is the minimum, 20% higher provision should be followed. This is the conclusion. So PSE approach, follow everywhere, answer the question accordingly. That was in the recent last exam, basically. Clear?
Yes, sir.
Any doubt till now? Any doubt? So quickly, if I talk about what is the NPA criteria, how many days if the particular asset remains overdue, it will become NPA?
90 days.
Very good, 90 days. Now for drawing powers, what is the limit of the stock statement?
3 months.
Yes, there's a difference. 90 days, 3 months. Remember that. Okay. Then, in the case of basically doubtful asset, in the case of the doubtful asset, what is the provisioning requirement?
Sir, less than 1 year, 25 percentage. 1 to 3 years, 40 percentage. More than 3 years is 100 percentage for the secured portion. Unsecured portion always 100 percentage.
Yes. So 25, 40, 100 is the requirement for the secured. Unsecured, directly 100. Okay. Plus, we will not take a advance which is covered by the central government guarantee as an NPA, but we will count that for the purpose of, we will count that advance as an NPA for the purpose of
Interest income.
income recognition. For the income recognition, still those will be counted as an NPA. For the fraud related scenario, if there is a if there is a deterioration in the value of security, now the NRV of the security is less than 50% of the original value. Which category you will classify the asset into?
Loss asset.
Less than 50. If there is a potential threat of recoverability due to fraud, the net realizable value of the security has been decreased below 50% of the original value. Erosion of the security. In which category you will classify that asset?
Doubtful.
Yes, doubtful.
Doubtful.
Very good, doubtful. Yes, Sarah, very good, doubtful. If the value of security falls below 10% of the original value,
Then it is a loss asset.
and And there is one more thing to be done.
Ignore security.
Absolutely correct. Ignore security. Do not consider security. I will not consider any secured portion in that. For me, it's an unsecured now. Clear? Any doubt till now? What is the additional provision on unsecured portion of a substandard asset?
Additional for 10% additionally.
Very good. 10% additionally, making to total 25% on unsecured portion. 15% general, 10% additional. And what is the provision requirement on the standard asset? General category.
0.4%.
Sir, 15%.
Standard.
Standard it's
0.4.
depends, sir. It's a depend 0.5, 0.75,
General category. General.
0.25.
0.4 percentage. General category 0.4 percentage. If it is a farm credit, housing loan, small and micro enterprise loan, 0.25 percentage.
Yeah. For that,
Commercial real estate 1%. Commercial real estate residential housing 0.75%.
For restructuring, it's a 5%.
Yeah, restructuring 5%. Clear? Any doubt till now, whatever we have discussed in this chapter?
So many data to be remembered.
Yeah. What I want from you guys, read the chapter. Whatever we have discussed, it's already there. We have seen it. Read the chapter and practice the questions as many as you can. We have covered a lot of things in today and the yesterday's session on the bank audit. But it requires your reading also. It requires your practice also. So you yourself has seen, so regulations are so many. Okay, so many different things are there. You can only understand if you read by yourself. We have discussed multiple regulations, multiple important points: asset classification, income recognition, investment, SLR, CRR, a lot of things we have discussed. But over and above that, it requires your reading also. Okay, so read the chapter, bring your doubt in the next session. Okay, or any of the doubts if you have, you can also ask the DOS in these sessions. I think every Wednesday you have a query session. So you can ask your doubts in those open house query sessions also. Okay, it was today also. Now the next session I think is on the 10th December. If not, ask in the next session, which is on the 8th December 2025. Okay, your next session on 8th December is on chapter number 15. Okay, please read that chapter. Read that chapter in advance so that when the sir takes that chapter, you should be able to understand and answer the questions, and it becomes easier for you to go through the things which are being discussed in the chapter. Okay? If no
Okay,
further
sir.
doubts, then I propose to keep this session till here. This covers our chapter number 14 completely. Unit A, Unit 1 and Unit 2 both. Okay, guys, then thank you. Thank you
Okay,
for
thank
your
you so
time.
much.
Thank you.
Sir,
Bye-bye.
you have clearly explained and shown all the direction and explained, and you provided a lot of illustration, and you have know that a small packet you have fabricated everything in a slow manner, and it's actually one of the great subject for me. I never studied this chapter, but it's very interesting for me to now. It's more interest. See the way you explained. It's no eager to study me as well in the more on this chapter, sir. Thank you
Thank
so
you.
much for your effort.
Thank you. Thank you very much. Thank you. That's the only my try that the student should be able to understand the subject. Thank you very much. Thank you.
Thank you, sir. Good night, sir.
Thank you. Good night.